XRP looks like a coiled spring. Price pulled back about 13% from its year-to-date high, but the setup underneath is getting stronger, not weaker. According to reporting from Crypto.news, the chart and the on-chain story now point to a potential break toward the $5 area. Source credited to Crypto.news. Let's start with the chart. Since January, XRP has carved a classic cup and handle structure on the daily time frame. The rim of that cup sits near $3.40. The base of the cup formed around $1.61 in February. Price completed the cup and is now working through the handle. Inside that handle, technicians can even spot a small inverse head and shoulders. That is the kind of pattern stacking that often precedes a decisive move. Momentum indicators back it up. Price is holding above the 50-day and 100-day exponential moving averages. That tells you bulls still control the medium trend. On Murray math lines, XRP just bounced at a key support and resistance band, which adds confluence. For confirmation, the clean trigger is a daily close above the year-to-date high at $3.65. If that happens with rising volume, the next magnet zone sits near the psychological $5 level. The invalidation line sits lower. A decisive break under about $2.73 would argue the handle failed and bulls need more time. Levels and framework as outlined by Crypto.news. The fundamentals on the XRP ledger are also improving. Total value locked on XRPL has climbed roughly 16% over the last month to about $85 million. Stablecoin balances on the network are growing too, now above $167 million, with Ripple USD or our LUSD seeing supply expand to roughly $642 million this year. More liquidity on chain means more potential activity, more fees burned, and a stronger base underpriced during pullbacks. These XRPL data points are summarized in the same Crypto.news report. There are also pipeline catalysts that could boost demand. Ripple expects to route hidden road transactions through the XRP ledger. The company's recent Rail acquisition is aimed at accelerating its stablecoin strategy, which could deepen our LUSD usage and improve settlement flows. If those flows land on XRPL, that is ongoing utility, not just headlines. Another big tailwind could arrive from the exchange-traded fund lane. With a pro-crypto SEC chair in place, Crypto.news notes that pending spot XRP applications could see approvals. Leveraged XRP ETFs from ProShares and Toycream already exist and have gathered assets, but institutions typically prefer spot funds. If even a fraction of the capital that chased Bitcoin and Ethereum ETFs rotates into a spot XRP product that is fresh, programmatic demand that does not care about intraday volatility. What does a trader or long-term holder do with this? First, know your levels. $3.65 is the breakout gate. $5 is the first big target zone if momentum expands. $2.73 is the invalidation for the bullish handle. Second, watch participation. Breakouts that stick tend to arrive with expanding volume and rising open interest, not a thin push. Third, track the ledger. If TVL and stablecoin balances keep climbing, dips are more likely to find buyers. There are risks. Pattern failure is always possible. If macro shocks hit risk assets or if ETF approvals get delayed, the breakout can stall. Regulatory headlines can also flip sentiment quickly. Respect your stops and position size so one trade never defines your month. Here is the bottom line. The phrase coiled spring makes sense here because you have compression on the chart, stacked bullish structures, supportive moving averages, and improving network fundamentals. If price clears the rim and confirms above $3.65, the path of least resistance opens toward $5. If it loses to $73 with momentum, the pattern needs to reset. We will keep tracking the key levels, the ETF docket, and XRPL activity as it develops. Today's analysis is based on reporting and price levels from Crypto.news. A small-cap crypto firm just made a very big move. According to Crypto, Bitmine Immersion Technologies plans to sell up to $20 billion of new stock and use the proceeds to buy more Ethereum. The goal is aggressive: build one of the largest corporate ETH treasuries in the world, potentially targeting a meaningful share of total supply over time. That headline is what has traders' attention today. According to Ambrypto's report on the company's filing, Bitmain expanded its at-the-market, or ATM, equity program by roughly $20 billion, bringing total capacity to about $24.5 billion. An ATM lets Bitmain drip new shares into the market over time when conditions are favorable. It does not mean the full amount gets raised tomorrow. According to Yahoo Finance, Cantor Fitzgerald is listed as the sales agent, and management has flagged that net proceeds are primarily earmarked for accumulating ETH, with some flexibility for mining expansion or other crypto initiatives. Why does this matter? Because Bitmain is already a sizable Ether holder. According to Cryptozard and other on-chain trackers, the company controls roughly 1.1 to 1.2 million ETH, which is around $5 billion at recent prices. If Bitmain keeps buying at scale via an ongoing ATM that creates steady, programmatic demand that can reduce liquid supply and amplify upside moves during strong markets, there's also a powerful narrative component. According to TradingView news coverage and Economic Times recaps, Bitmain's stock erupted after it pivoted from a pure mining story to an Ethereum treasury story, drawing comparisons to MicroStrategy's Bitcoin playbook. The shares spiked dramatically, then cooled, and later got another boost when, according to those same outlets, Peter Thiel disclosed a significant stake. The market loves a simple thesis, and public company as ETH accumulator is as simple and viral as it gets. Let's talk mechanics for a moment. According to Ambrypto's summary of the ATM terms and Yahoo Finance's follow-ups, underwriter commissions on these programs typically run a few % of gross proceeds. Bitmain pays that fee as it sells shares, then deploys the remaining cash into ETH. The trade-off is straightforward. Existing shareholders face dilution from new shares, while management bets that the ETH on the balance sheet will outpace that dilution over time. It's essentially a leverage via equity strategy on Ethereum. What could this mean for ETH itself? According to market data on TradingView and flows tracked by ETF watchers, Ethereum has already been buoyed by spot ETF inflows and shrinking exchange balances this summer. If even a fraction of Bitmain's headline ATM capacity ends up as real ETH purchases, that's a persistent bid sitting under the market. Add steady institutional inflows and you have supportive tailwinds into the next quarter. Of course, ATM is our discretionary. According to Crypto and Yahoo Finance, the company will only sell shares when it thinks conditions are right, so deployment pace may ebb and flow. There are obvious risks. According to Economic Times commentary on similar treasury plays, new share supply can weigh on Bitmain's own stock, especially if the market perceives the company as selling too aggressively. ETH's volatility cuts both ways. A sharp drawdown would mark to market the treasury and stress investor confidence. Execution matters too. According to CoinDesk's recurring coverage of corporate crypto treasuries, building and safeguarding multi-billion-dollar holdings requires airtight custody, disclosures, and risk controls. And any large, market-moving corporate accumulation is likely to draw regulatory attention to transparency and market integrity. Here's what to watch next. First, according to Ambrypto's reading of the filing, management will provide periodic updates on ATM usage. The key is the pace of actual sales versus headline capacity. Second, on-chain tracking from services like Cryptozard can help confirm whether Bitmain-linked wallets are net buyers of ETH over time. Third, listen for clarity on allocation targets, any hedging practices, and custody arrangements in upcoming company updates. Finally, watch the macro backdrop. According to TradingView's aggregate data, if ETH keeps grinding higher alongside ETF inflows, a bear scaling in over months can have real price impact. If macro turns risk-off, the ATM could slow or pause. Bottom line. According to Crypto, Bitmain has positioned itself as the MicroStrategy of Ethereum. If it executes on even part of this 20 billion plan, it becomes a persistent source of demand for ETH. If it stumbles, shareholders eat dilution without the treasury lift. For traders and long-term holders, this is a story to keep on the radar through the rest of 2025. Remitix is rallying again, and the next catalysts are almost here. According to Crypto.news, the payment-focused token has climbed more than 500% in 2025, and is now approaching a key milestone that could unlock its first big exchange listing. Here is the headline. The team says the first centralized exchange listing will be revealed when the project's presale crosses $20 million. According to Crypto.news, the raise is close to that mark, and momentum has picked up into mid-August. There is also a product update on the calendar. According to a recent Yahoo Finance press release, the Remitix wallet enters beta on September 15th with access for a select group of community testers. That timing matters because a live wallet and an exchange listing create a one-to narrative for adoption and liquidity. So what is Remitix trying to do? The pitch is PayFee, a bridge between crypto balances and real-world payments. The project highlights low fees, fast settlement, and a path to move value into bank accounts across borders. Ainvest's coverage adds that the wallet and fiat rails are central to the roadmap and that hitting the 20 million threshold is the trigger for the first listing announcement. Why is the market reacting now? According to Crypto.news, investors have been rotating toward payment tokens with clear utility while they wait for the next broad leg higher in majors like Bitcoin and Ethereum. In that context, a token that posts 500% gains year to date, then lines up a wallet beta and a listing reveal, becomes a story traders want to ride. There are also those speculative tailwinds you see every cycle. Media pieces and social chatter amplify each checkpoint. CoinCentral's roundups note analysts talking about outsized upside if user numbers grow through the wallet, then accelerate post-listing. The simple version is this: deliver a working product, get more users, and liquidity follows. Here is how to think about the timeline from an investor perspective. First, watch the presale counter. According to TheStreet's write-up, the team reiterated that the listing announcement drops once the 20 million figure is reached and that the wallet beta schedule is locked for September. Second, watch for exchange marketing. If a top-tier venue is involved, day one liquidity improves. Third, watch the first week of wallet telemetry. Active users, transactions, and retention will tell you if this is sticky utility or just launch week noise. It is important to be clear about risks. Crypto.news labels the Remitix item as partner content, which means it is sponsored material, not independent reporting. Treat claims conservatively and verify updates through official channels. Presales and fresh listings are volatile. Prices can spike on headlines, then retrace sharply when early allocations unlock or when hype fades. If you engage, size positions carefully and plan exits ahead of time. Bottom line. According to Crypto.news and supporting coverage, Remitix is entering a catalyst window. A wallet beta in mid-September, a first exchange listing announcement at the 20 million mark, and a year-to-date run that has the market's attention. If the team executes, product plus liquidity can support the next leg. If timelines slip, sentiment can turn fast. We will keep tracking the presale progress, the listing reveal, and the first wallet metrics as they land. XRP is back in the spotlight, and the big question is simple: where could it be in 5 years? According to the Motley Fool's latest 5-year outlook, the base case is pretty grounded, reclaiming the old all-time high near for dollars as network adoption grows and legal clarity improves. In their bull case, analysts see room for a much larger move if institutional demand and real-world payments usage scale together. A key piece of the long-term thesis is utility. According to the Motley Fool, Ripple's strategy isn't to replace SWIFT overnight, but to win specific payment corridors where speed and cost really matter. That's the wedge: prove out cross-border settlement in targeted routes, then expand. If that roadmap keeps working, XRP benefits from more transactions, deeper liquidity, and stronger network effects. Institutional access is the other pillar. According to Yahoo Finance's syndication of the Motley Fool analysis, a reasonable near-term milestone is $5 within the next couple of years if ETFs, treasury adoption, and exchange liquidity keep improving. Longer term, one Motley Fool piece even modeled scenarios where XRP's network value could approach the mid-hundreds of billions if adoption accelerates. None of that is guaranteed, but it shows how much the trajectory depends on mainstream rails opening up. There's also the 2029 lens. According to a recent Motley Fool update, research from Standard Chartered's Jeff Kendrick puts a possible 2029 target above $12 if global payments and investment flows compound from here. That would be roughly a quadruple from the $3 area where XRP traded when that call was published. On the execution side, Ripple keeps laying bricks. According to the Motley Fool's coverage this month, the Hidden Road acquisition could plug XRP into more traditional prime brokerage plumbing, which matters for larger institutions that need compliant, reliable access. The more XRP moves through standard market infrastructure, the easier it is for conservative capital to participate. Now for the guardrails. According to the Motley Fool and Nasdaq's reprints of that 5-year discussion, the bear case is straightforward. Without steady, measurable traction in real payments, XRP can stay range-bound and underperform. There's also market cap gravity to respect. Big caps don't compound like microcaps unless fundamentals truly inflect. And regulation can still change the path and timing, even if the direction of travel has improved. So what should you watch over the next 5 years? First, corridor wins that translate into volume on the XRP ledger. Second, institutional on-ramps like spot, ETFs, custody, and brokerage integrations that make it easy for big allocators to buy and hold. Third, price milestones that line up with those fundamentals, reclaiming for dollars as a base case, testing $5 on stronger flows, and then, in a true bull environment, stretching toward double-digit scenarios some analysts have floated for the back half of the decade. Bottom line, according to the Motley Fool's 5-year framing, XRP's upside lives and dies with real-world usage and institutional access. If Ripple keeps winning payment corridors and Wall Street pipes stay open, the next 5 years could look very different from the last 5. If not, expect chop, not moonshots. A tweet from a former Monero lead developer just lit up CryptoX, and the flashpoint is XRP. According to Bitcoin.com news, the developer shared that a close friend, who had always been skeptical of crypto, suddenly wanted to buy XRP, and that single post exploded into a culture war debate across the timelines. Here's what happened, and why it matters. According to Bitcoin.com news, the post went viral because it touched a nerve. Is mainstream attention shifting toward assets with clear payment narratives and brand recognition? Even among people who ignored crypto during the last cycle, the replies quickly split into camps. XRP supporters argued that real-world payments, regulatory clarity, and rising institutional interest make XRP an obvious on-ramp for newcomers. Privacy coin advocates fired back that XRP is too centralized and too compliant, and that it undermines the original cypherpunk vision. To understand why the debate got so heated, it helps to revisit the two projects. According to Wikipedia's technical summary of Monero, the network's design prioritizes privacy by default with tools like ring signatures, stealth addresses, and Ringed, which makes transactions hard to trace on-chain. By contrast, XRP sits at the center of Ripple's enterprise payment stack, where speed, liquidity, and compliance are the selling points. Those are different missions, and they attract different tribes. According to the Bitcoin.com news headline recaps being syndicated on CoinGecko's XRP news feed and the Cryptorunk aggregator, the story kept trending through the day, which tells you this wasn't just niche drama. It struck at a bigger question the market wrestles with every cycle. What wins adoption first? Radical privacy or seamless payments that plug into banks and fintech rails? Zoom in on the XRP side of the argument. Supporters point to growing usage of Ripple's payment corridors, stablecoin initiatives, and the ongoing push for exchange-traded products. According to Bitcoin.com news framing of the discussion, the friend wants to buy XRP moment was used by XRP holders to claim that brand familiarity, large cap liquidity, and perceived regulatory progress are drawing in fresh retail attention again. Zoom in on the Monero side. Advocates argue that convenience without privacy is a trap. According to Wikipedia's Monero overview, the project exists to make transactions fungible and untraceable by default. For that community, compliance-first systems miss the point of crypto's founding ethos. That's why a former Monero lead developer becoming the accidental spark for an XRP hype wave felt like heresy to some. There's also a market structure angle. According to coverage trackers like Cryptorunk and CoinFi, posts about XRP dominance, RSI momentum, and next breakout narratives tend to go viral in clusters when retail interest rises. That creates feedback loops, more social reach, more searches, more short-term flows. Privacy coins rarely get the same mainstream boost because major US exchanges avoid them, and that distribution gap shows up in the discourse. So what should you watch next? First, watch whether this attention translates into actual on-chain activity or exchange flows. Viral posts are loud, but wallet creation, payment volume, and liquidity tell the real story. Second, watch policy commentary. The debate exposed a philosophical split that is also a regulatory split. If US and EU policy keeps favoring transparent, institution-friendly rails, assets like XRP will continue to benefit from easier listings and broader access. If privacy rules soften or more privacy-preserving compliance tech emerges, Monero-style designs could regain momentum. Third, watch how creators and news desks frame the next leg. According to Bitcoin.com news, the spark came from an anecdote about a friend crossing the crypto chasm. If more stories like that pop up, it's a signal that the casual investor is re-engaging, and those moments tend to drive the early stages of trend shifts. Here's the bottom line. According to Bitcoin.com news, a single post from a former Monero lead developer about a friend wanting to buy XRP set off a wider identity fight inside crypto. On one side is the payments-first, compliance-friendly path that brings big pipes and mainstream users. On the other side is the privacy-first path that protects individual freedom at the potential cost of convenience and distribution. The outcome won't be decided on X, but the conversation tells you where retail attention is drifting right now. And attention is the fuel that moves markets. Avalanche just pulled back on price, but the network is heating up under the surface. According to Crypto.news, AVAX tapped about 25.6 for dollars on August 18th, then slipped toward the $23 area with the broader market sell-off. Even so, the chain's usage is spiking. Here is the headline you need. According to Crypto.news, on-chain analytics from Nonsen show Avalanche daily transactions jumped more than 100% over the last month, climbing from roughly 500,000 per day to over 1.3 million per day, with most of that surge arriving in the past 2 weeks. That is classic divergence, price cooling, while activity accelerates. DeFi traction is firming up as well. According to Crypto.news, Diffalama data shows total value locked on Avalanche, ticking higher from the April 2024 lows, and stablecoin growth has been one of the key supports for that trend. More stablecoin liquidity usually means tighter spreads, easier routing, and a better experience for users and apps. Narrative catalysts are stacking. According to Crypto.news, real-world asset tokenization on Avalanche keeps getting headlines. Bowmore, one of Scotland's oldest distilleries, launched tokenized whiskey bottles on AVAX, and back in July the ecosystem highlighted about $250 million of RWAs coming on-chain via Grove. There is also a Visa tie-up for global stablecoin settlement that keeps Avalanche in the payments conversation. What does this mix of falling price and rising activity usually mean? It often says builders and users are leaning in while traders de-risk on the edges. If usage holds, price tends to catch up. According to Crypto.news, analysts looking at this backdrop think AVAX has a credible setup for a renewed breakout once the market digests the latest profit-taking. Key things to watch over the next few weeks. First, transactions and active addresses. If daily transactions stay near or above the 1 million mark, that confirms sticky demand. Second, TVL velocity. If TVL keeps grinding up alongside stablecoin balances, DeFi revenue and fees should follow. Third, RWA and payments pilots. If the tokenized whiskey drop, Grove's pipeline, or the Visa settlement work spawn follow-on launches, that strengthens the use it, don't just trade it story. All of these checkpoints were flagged in the Crypto.news roundup. Risk check. This is still a high beta asset. If Bitcoin and Ethereum extend their pullback, Alt-L1s usually take the bigger percentage hit. And while our WAs and payments partnerships are promising, they need real volumes to matter. If volumes don't materialize, the narrative fades fast. Those caveats are implicit in the same Crypto.news coverage. Bottom line. According to Crypto.news, Avalanche activity is ripping higher even as AVAX cools, with Nonsen flagging a move from roughly 500,000 to 1.3 meters daily transactions. TVL climbing off the floor, and fresh RWA and payments catalysts in flight. If those fundamentals persist, the price action has a foundation to build on once risk appetite returns.